What's up, everybody? Good morning. It's Jonathan. So, Wednesday, I put out a video and I said, be careful, added risk, the market may sell off. Well, yesterday, and I always appreciate the feedback, I always appreciate the activity, but literally within like 3 minutes of the opening, the email started coming in saying, you're wrong, you stink. Hey, has the market crashed yet? What's going on over there? All these different comments. And I think that the majority of people understood what I was saying, but there's definitely a subset that was very confused. Overall, let me reiterate my message. And I'll attach the video from Wednesday that I put out because been trading for 18 years. I am not putting out videos so you guys could see, wow, look how prophetic that Jonathan is. He knows exactly what's going on. Absolutely not. I'm managing my portfolio. I'm looking to protect my portfolio. Right now, with what's going on in the market, with the uncertainty, with the shape of the yield curve, the market behavior just doesn't make sense to me. And right here, I have 2s, 10s in front of you. And if I put 2s, 10s on a longer time frame, when it's going down, the relationship between 2-year and 10-year rates is getting closer and closer together. The yield curve has gotten inverted 9 times in the history of the stock market. And 9 times it's been a predecessor to a recessionary environment. So let's look at this graphic, the spread between the 10-year and the 2-year yields. June 9, 2.5%, 2.5%. June 17, 0.8%, 0.35%. Today it's even lower. The yield curve is flattening even more because of uncertainty. So if we look at the risk in the overall market, the reason why I put out that video Wednesday was because I am no longer comfortable with the risks of staying long this market. That's the overall message. We're in the business of risk management. That's what separates people. I think you'll find, and it's tough to say because some people are going to say, bullshit, that's not true. The longer you trade, the more you'll realize that it's not going to be that difficult to find winning trades. You're going to have winning trades. What's going to be difficult is going to be avoiding those big losing trades. And the way that you do that is being proactive. And when I see an environment and someone who follows the bond market very, very closely and the shape of the yield curve very closely because of its effects on the overall economy, like you should, like I teach my coaching clients to do, when you see a major structural change like the flattening that's going on, plus the US president is negotiating with North Korea, tariffs going on left and right, at any day things are changing. We have VIX darn close to all-time lows. The overall message of Wednesday's video was, I want my portfolio to be angled toward the short side because I think there's a much higher likelihood of us trading lower than us trading higher at present levels. So I'm not calling anybody out, but when I'm receiving emails 5 minutes into the trade on Thursday saying, Jonathan, you're a dummy, the market's not selling off, I shake my head because that person doesn't understand what we're looking to do. Right now, my bias, without a doubt, is I want to be long volatility, long the VIX, and I do that by buying options. You can buy calls, you can buy puts, you can buy straddles, you can buy strangles, you can do any kind of debit spreads. That's going to get you long volatility. Any of those trades will be working as the VIX goes higher. The other thing that I want to do is I want to angle my portfolio to benefit from the market selling off. If the market rallies, if I'm wrong, I'm comfortable losing money. I don't even think I'll lose money because I still have good trades. We're long, good companies. I've researched the heck out of these trades. But overall, if the market does get hurt, not just trades off, I'm talking about if all of a sudden we get down to 2,600, I want to look back and say, you know what? The yield curve was flattening. Historically, I've seen it happen or read about it happening 9 times. After that's happened 9 times, we fall into a recessionary environment, which means the markets overall have gone to a long period of very, very difficult trade. I want to make sure that I benefit from that because I don't mind losing money on good trades. If I do research like WWW, which we lost money on, longer term members, we lost money on. I had a thesis for that. I don't mind losing money on that. I still think my thesis will be right. I just think my timing was not right. What I can't stomach losing money on is seeing the yield curve flatten, knowing what it's done historically, and sitting on my hands and not proactively making a decision to protect, defend my portfolio. So I appreciate the feedback. Without a doubt, I got 10 emails yesterday saying you were wrong. Or day traders just looking to sell NQ and buy it back when it goes off 4 ticks. That's not a good play, guys, because what you're doing there is you're risking more on the upside than you're willing to make on the downside. The key lessons is it's okay to make a whole bunch of money on one trade. So if you're selling NASDAQ and you're right, get out of the way. Let it go. I think there was a darn easy opportunity yesterday. If you look at the S&Ps, and again, this market is going to get hurt, okay? When I start having an opinion like this, and I'll be a little arrogant right now, I'm pretty darn good, okay? Yesterday's high of the S&P, 2794. The day before, 2796. The day before, 2794. The day before, 2794. The exact same high. Maybe not to the tick, but within a point or within 2 points. That is really telling. And now the high of today is going to be 2779. The low of yesterday, 2781. The low of the previous day, 2778 or 79. So it makes sense. Get out of the way right now. We want to take our entire portfolio and make sure that the overall deltas in that portfolio are short. So that means if we break it down to the simple common denominator, if you're long 100 shares of Microsoft and you're long 10 puts in Apple that's in the money, your portfolio is probably going to be short deltas because those 10 puts are going to be equivalent to 1,000 shares short Apple, and you're only long 100 shares of Microsoft. That doesn't mean cover the Microsoft. That means if you look at your portfolio as one position, in that example, you're short deltas, okay? Overall, that's my message. That needs to be learned. What I'm doing, and I trade for a living, is I'm trying to walk you through exactly what I'm doing. I'm not trying to do it one day, give you an idea, cover that day, and pound my chest that I'm awesome, okay? Not me. Overall, we want to have a plan, we want to have a bias, and we want to educate ourselves. The reason why I think the market's going down right now is because the yield curve is just too darn flat. The proper way to hedge that is you can get long pieces of the yield curve that are inexpensive relative to the rest of the yield curve while holding an overall short bias in the market. That's not easy. That needs to be learned. And for those looking to really learn that for the long term, send me an email. support@activedaytrader, because that's where I can really help you. Thank you. Love you guys. A little emotional. I was a little frustrated getting all that feedback. And I also did get some great feedback yesterday. Jonathan, thank you for letting us into your world. Thank you for sharing your opinion. Great. But for some reason, the ones that were negative always stand out at me because it's frustrating. Trading is frustrating. We're all in this together. Okay? You guys are awesome. Thanks for listening. Support at Active Day Trader if you have any questions.